that took the market by surprise. Basically, the number of members who saw a rate hike in 2023 rose substantially, a huge shift, implying a tapering of their monthly bond buying in the near future. John, your thoughts about how big of a deal this week was?
Well, I mean, my first thought was to kick myself for not having seen it coming, because there were plenty of little hints dotted around that they were prepared to start moving the narrative, to shifting it slightly. Another thought, obviously, is that it's rare to be able to be quite so hawkish and have quite such a hawkish effect without raising a single feather or bearing a single talon. Like they've said, we think we're probably hiking rates twice from zero where they are now in the next 30 months. And that, in the current conditions, counts as seriously hawkish.
Hold on a second. Okay, seriously hawkish, correct. We have to have an asterisk, and seriously hawkish today would be, 15 doves back 30 years ago. That said, the implication being that they have to start tapering the $120 billion of monthly bond purchases, which is a big deal, and they would have to start fairly soon if they wanted to get to that 2023 level. That is a huge mystery, how they taper, how quickly, when they start, the implications at a time when the U.S. is selling a record amount of debt to fuel its deficit. To me, this is the significant aspect.
No, I agree completely with that. And certainly for the foreground, now that they think they've got rates rising 2.5 years from now, that means they have to have tapered first. That's the precedent that we've set from the last time the Fed tried to stage a retreat. And when the question is about liquidity, about being able to roll over the immense amounts of debt that is out there, if the Fed is going to be steadily injecting less money, making it easier to roll over debt as they are now, that is potentially very significant for the credit markets. The risks of accidents as we start the descent are definitely there.
Okay, but here's the weird thing. You would expect that if rates rose. They did not. Longer-term rates fell. That basically the implication here, short-term rates rose to the highest levels in a year, people expecting those rates to be risen, to be hiked by the Fed. That would curtail long-term growth. You get that flattening a yield curve, a pretty whipsaw flattening, if you will.
Amazing.
This would be oddly supportive for risk assets because you still can't get return on the long end. I mean, this is sort of a circular kind of logic if you are in an economic recovery.
It's the thing is perhaps that you're not actually in an economic recovery. This comes back to your most underestimated risk from last week, which I have to say was an extremely good call, that there is more concern out there that actually we're not going to be recovering all that much, and that actually we're not going to jolt ourselves out of the sort of general conditions we all grew to know and dislike in the post-crisis decade. That if you have that much of a flatter yield curve, that implies that the market is really confident that we're not going to need particularly high rates. The other thing there is the five-year break even. The predictions for whenever it's from 26 to 31 now has really come down very hard. Like, again, there is really no great fear at all suddenly that there will be any lasting pickup in inflation, which implies sluggishness. We've all learned again over the last decade or so that you can have a sluggish economy and risk assets can do very well, but it's a very complicated, counterintuitive situation. Yeah, carry on.
So complicated, and it's derivative of derivative of derivative.
Yeah.
There is a happy medium here, and no one has ever accused me of being overly optimistic, but this is the view that I'm hearing from certain investors, Jim Keenan, for example, of BlackRock, who still likes high yield debt and some of the riskier credit. And he's saying, look, just because the yield curve is flattening doesn't mean we're heading into an economic slowdown. It just means that the risk of overheating and runaway growth and a new paradigm of expansion is not the case. We're not sort of jogged into some new reality of faster growth and 1970s style inflation. It's just that the Federal Reserve will act to curtail sort of runaway inflation. So we will have a longer economic recovery. And that could be supportive of risk assets. Herein lies the rub, though. to your point, and I think this is a good one, what is the line between a softening in the recovery and a slowdown that becomes unsustainable given the debt load that's been incurred during the past, 2 decades, frankly, but certainly over the past year?
Well, the line is a very difficult one to draw, and I am personally somewhat concerned that people aren't thinking about this more, because I also tend not to get accused of being an optimist too often.
We get along, if anyone is wondering. We do get along very well.
Just don't know why. But yes, you have this overriding fact of this very large amount of debt that's out there that has to be dealt with, and some growth would be really quite handy to help deal with it. Some inflation would be really quite handy for making any given level of debt that much easier to deal with, because it inflates away. It's not that long ago that Jay Powell at the Fed was convincing us that the narrative was, yes, we actually want a new paradigm. We do actually, Jay wanted to be the inverse Volcker who convinced us that he was really more worried about unemployment than inflation. And I thought in his press conference, that was perhaps the most convincing thing in really suggesting that he was stepping back from that, was that he gave us this long laundry list of reasons why persisting disappointingly high unemployment was going to be transitory.
Okay.
Go on.
My takeaway from that press conference, the reason why I thought that it was so fascinating, was because it highlighted to me a dissonance on the Fed, disagreement among the members, a split that is becoming more bifurcated between the more hawkish leaning side and the more dovish one. Yes. And I think that Jim Bullard, when he was speaking on CNBC this morning, really hammered that home, saying that this was Fed Chair Jay Powell kicking off the tapering talk. That's much more definitive than Jay Powell himself was making it out to be, because Jay Powell leans on the more dovish side. But the idea that there is so much disagreement and that some of the doves are getting sort of overwhelmed by the hawks signals a certain degree of volatility, a certain degree of monetary policy unpredictability in the months to come, which to me is a sea change, frankly, from the constant dovish tilt.
Yes, I agree with that completely. Two points to make to that. One is Jimmy Bullard, of whom I'm very fond, does tend to be an outlier in both directions.
A non-voting member.
Yes, but yeah, he still matters. I'm not saying he doesn't matter, but if this had been the president of the New York Fed or something, that's saying that would have been a bigger deal than Jimmy Bullard saying that. But the other point, one of the things that fascinates me, obviously there was all great interest about the median dot plot for 2 years hence rising, the median rose. But the other thing that was fascinating was there were very few particular points in that dot plot which had more than 2 dots. The spread of expectations by the different governors for what they're going to do by the end of 2023 was very, very wide. So there are, not only is there a division going on, but there's quite a number of people who are biddable as to whether they're going to be hawkish or dovish. It's the kind of thing it's like the kind of argument that people sometimes get into with the Supreme Court, where people know exactly what previous ideology one person has had or another, that somebody might show up as the swing hawk, the hawk that becomes the dove or whatever.
The swing hawk, I love it. Yeah. Well, so, we normally do the overplayed risk and the underplayed risk. And I don't know about you, but my overplayed and underplayed risks all have to do with this certain scenario that we're in right now, with the potential for a Federal Reserve to become hawkish. And I had an overplayed risk. Do you want to go first, or would you like me to start?
Okay, I'll go first, because maybe we might go. I think my overplayed. I think the overplayed risk is that the reopening trade is dead. That there has been such a complete move away from it in the last 48 hours. The bonds are actually beating stocks, that we were worried. The fact that bonds and stocks have moved so dramatically in the opposite direction from each other when it looked as though they were becoming correlated, which is a sign that people are really worried about inflation, and that now we're back to worrying about growth. I think that's I think there were a lot of reasons people did believe in the reopening trade, and I think there may be an opportunity to re-enter it being created at the moment.
So you think that the sort of idea of reflation will reassert itself?
I think the chance that it does is being, I'm sorry whether I can't remember whether I was supposed to give you an understated or overstated. I think the chance that it comes back is being understated at present, that there are the reasons why we were worried about inflation weren't entirely that we thought that the Fed was going to be make a dovish error and stay lower for longer. There were lots of other reasons that sounded very convincing only a few days ago for why we needed to be worried about inflation.
Okay, to exactly that point, my overplayed risk is similar, and that is taper tantrum.
Yes.
And I actually think that that has become an overplayed risk, the idea of bond yields shooting higher as the Fed tapers. I think that the market's response to the threat of a more brought forward schedule of tapering the monthly $120 billion bond purchases shows that actually longer dated yields are more inclined to fall than to rise in response to this, which to me is fascinating. Also, the dollar strengthening, right? The fact that people come back into the United States. If that's the case, how could we get the same kind of taper tantrum as in 2013 with credit and even investment grade credit if people want to come into U.S. assets? You know, if we're not seeing that kind of inflationary push in the rest of the world with rate rises in the likes of from the ECB and the BOJ.
Yeah. First of all, I completely agree with you that there was, I thinking, one of the they're taking the risk of a taper tantrum. Let's see if we've had our taper tantrum and then seeing very significant falls for the 10-year yield was exactly the opposite of what I was braced for. And again, you sort of kick yourself once you're working your way through the logic. On the risks of a taper tantrum, though, the other point that bothers me is the last taper tantrum was most painful for the emerging markets. And while emerging markets are steadily becoming less sensitive to the dollar, which has been a deliberate policy so that they're less, a stronger dollar doesn't directly hurt them because they don't have as much dollar denominated debt as they used to. There are some exceptions to that. So that is the one area where I would see some reason for concern is whether the strengthening of the dollar ends up creating some issues for emerging markets.
So I'm smiling.
Yes, the risks. Sorry, carry on. Yeah.
No, I was just going to say I'm smiling, not because I want to see that, because I don't, especially given how much debt that those regions have, and frankly, the fact that the economic recovery has been slower, but because on my list, my most underplayed risk was a real disruption in emerging market credit. Exactly to that point, the idea of if you do see a taper and then a decline in longer term yields and a strengthening in the dollar, as Matt Hornbach of Morgan Stanley expects, terrible for emerging market credit.
Yes, there is still, I think there are good reasons to think that the other aspect that has been given to be positive about emerging markets that could turn negative, given the way the narrative is moving, is obviously most of them are commodity producers. In 2013, the commodities were settling into quite a severe bear market. Obviously, the great hope was, well, this time around, we're worried about inflation and commodity prices are rising. They are, at this moment, falling. Maybe a head fake, but that's another reason for concern about emerging markets. It's perfectly reasonable to say that they're not as vulnerable as they were in 2013. They aren't, but some of them do have particularly serious problems with COVID, and some of the reasons we weren't so worried about them are beginning to change. So the hope we were going to do a Siskel and Ebert routine is continuing to be a little thumbs way up from me for that understated risk.
And I guess that unfortunately or fortunately, you and I think similarly. I will say the Fed managed to land a really nuanced message brilliantly, though. Yes. They managed to inject a moment of caution into markets where people were increasingly worried about financial risk and things getting frothy. And they did it, as you said, without lifting a finger. They didn't have to really do much. All they had to do was change around some dots. I mean, obviously, there's more to it than that. But it just, frankly, they're finessing it impressively.
Yes, and the fact that we've got that a decade more experience of how you deal with life when interest rates are already virtually zero perhaps has helped them. But the way that is another point. I do feel that what Jay Powell was perhaps most concerned about was not to see his words turn into a sudden big rise in the 10-year, which was a perfectly reasonable fear, as we both agree. And he should be feeling very pleased with himself that that's what he hasn't produced. That's very, very positive.
Well, let's see what happens tomorrow, or I should say on Monday, since it is Friday. Yeah. That's it for us. We have run out of time, but next week we will be back. And as always, it's a joy to be with you, John.